Is Monster Beverages a good investment option for me? Well, it is a very special company which exemplifies terrific fundamentals, but stay until the end to see whether it will go in my portfolio and why. As always said with educational purposes and is not meant to be taken as financial advice. Not a lot of people know this, but over the last 2-3 decades, Monster has been the best performing stock in the US. It has crushed the returns even from companies like Amazon and Apple, as seen here from 01 until now. Monster is up more than 100x. While the other two top tech stocks are up by around 40x. The global energy drinks market size was valued at around $46 billion in 2021, and it is estimated to grow to about $108 billion by 2028, growing at an annual growth rate of approximately 8.15%. In general, this is a good industry growth rate, showing the energy market is healthy in terms of future potential. According to GNW, the biggest catalyst for the industry is the increasing physical activity, which will propel the market forward. The biggest risk for the industry is the concerns over false marketing, in which energy drink brands are promoting themselves as healthy options to hydration. When it comes to the market share in the US, the dominant player is Red Bull with a 45% share, and after that comes Monster with 30.1% share. I have read all of Monster's 2022 company results, and let's now go through the most important stats. In Q1, they grew by 21.1%, in Q2, they grew by 13.2%, and in the latest Q3 report, they grew by 15.2% year-on-year. This is a good growth rate as it is above the inflation rate in all developed markets, which means the growth in Monster's business is real growth. We find the real growth when from the nominal growth we subtract the inflation rate. The growth of 2022 is very impressive, especially when taking into account that most other companies are lagging in revenue and business demand increases. On the next provided chart via macro trends, we can see the 2020 growth is no fluke. As far as the chart is showing us, all the way since 2010, Monster has never had a full year without growth. What is even more impressive is that in only 2 instances, they had a slight negative quarter-over-quarter growth, with the average growth rate for the period being between 15 to 20%. Money can be made even from businesses which do not even grow, but when we have such a grower in our hands, it is even better. But always remember, there are other very important things to watch out for, like the valuation of the company, as even with a very high growth, if the price of the company is just too high, the investment still could turn sour. Also, the debt and efficiency need to be checked upon. What has really amazed me when it comes to Monster is that they do not have any long-term debts. This means their balance sheet is impeccable. In times filled with debts that risks, to have a company which does not have any debt is truly amazing, and it shows just how real their growth is. I cannot think of any other business from the top of my head in the same position. When it comes to their short-term debt health, it is also impeccable with a current ratio of 4.2. This means that the current assets are 4 times larger than the liabilities. From an efficiency standpoint, the return on invested capital is extremely good with 26.16%, while the ROE is about 19%. To have such an ROE without any debt use is rare, like a 10-leaf clover. A bit of a negative for the company from an efficiency perspective is the drop in the net margin. During 2021, it was at its peak at over 30%. Now it is closer to its average level of 20%. Most likely, this is due to higher production costs caused by inflationary pressures. Last but definitely not least, we must check upon the earnings multiple. For this, I always like to use a historical context, and via macro trends, we can see that. The current PE multiple is 45, which is just too high for Monster, with an average growth rate of 15 to 20%. According to the Lynch rule, such a growth rate should not come hand in hand with a PE of over 20 to 25. The multiple of the company should always be a reflection of the growth of the business, its debt security, efficiency, and its competitive moat. The highest I could go for Monster is about 25 to 27. I am okay to pay a bit more as I am a huge fan of the no long-term debt levels and the very high efficiency, but 45 is just too high for me. In general, I qualify Monster as an absolutely terrific business, which is just too high for me to buy at these current price levels. If the price goes lower, I'll make a follow-up analysis, so subscribe for this and many more stock analysis videos, and don't forget to like the video if you feel you learned something new. So goodbye for now and until next time.